All right, hello everybody, and welcome to Sunday Option Q&A. I'm your host, JamesLegends. We do this every Sunday in the Discord at 8 p.m. Eastern Time. It is a 1-hour stream, and sometimes it's in the free section, sometimes it's not. Today it happens to be in free. I just want to also say Happy Father's Day to all the fathers out there. Thank you all for attending the stream today. I have a few things planned for today that I wanted to go over, a few indicators that I want to talk about, and then also a couple of different types of option strategies that I want to talk about as well. So we're going to kick it off right away. We're going to start off by talking about RSI. Okay, RSI is an indicator that a lot of people use in their trading, right? It's a very common indicator that's being used. But I also feel like I see a lot of people using it incorrectly sometimes. So that's why I wanted to go over this today. All right, so first of all, let's talk about what it means. RSI stands for your relative strength index. Okay, so your relative strength index measures the magnitude of recent price changes to evaluate overbought and oversold conditions in the price of a stock. So in other words, when you see the RSI level above 70, it can be considered overbought, and when it is under 30, it can be considered oversold. There are a few different types of RSI indicators that you could look at too. RSI 6, 14, and 24 are some of them, to name a few. Now, all that number next to it means is the amount of days that it's taking into account to measure the relative strength. The one that I generally use is this one here, RSI 14. Okay, that's a very common one that a lot of people use. I know people also use the 6 and the 24. Sometimes to find more oversold conditions, you want to use the 24, or if you want to find more short-term oversold, overbought conditions, you could use the 6. But I like that median on the 14. That's my favorite one to use. Okay, just because the RSI is oversold now doesn't mean that you want to buy right away. There are other factors that affect the stock's price, such as news, market sentiment. So always make sure to try and confirm a bottom before jumping in just because it's oversold. And I can't stress that point enough, because I think that I see a lot of people looking at the RSI and always seeing, oh, it's oversold, it's got to be the bottom. When it's not the bottom yet, just because RSI is oversold doesn't mean it can't stop, it can't keep dropping. And just because it's overbought doesn't mean it can't keep going up. We've seen many situations where the RSI is sky high. We see it at 80, 85 on the RSI, and yet the stock still continues to go up. And the reason for that is just because of momentum, number one, market sentiment. Maybe they had some good news, whatever it may be. But this is not an indicator that you want to use alone by itself to find your entries. Okay, this is something that you want to use combined with other things, at least in my opinion. Now, there's also one other way that you can use the RSI, and this is by looking for divergence. Okay, so there's two different types of divergence. There's bullish divergence and there's bearish divergence. So I'm going to come over here to TradingView to talk about this now. I'm going to slap on my RSI. Here's my relative strength index. Okay, we're going to make this bigger so that we can take a nice good look at it. Okay, so here's your RSI. Pretty much the yellow line is the important one, right? So basically, when this comes down to this level here, this is showing you that this could be a support area, right? But as you could see, the RSI came up here, and then it still ended up dropping down lower than it was over here, right? So that's why I'm saying we don't want to use RSI by itself. Now let's talk really quickly about the two different types of divergences that we could find using RSI. So for this, I'm going to switch over to the 5-minute chart, and we're going to look at this little pattern right here, these candles, this little section right here on Apple. Okay, so this is your Apple 5-minute chart. So this right here would be a good example of bullish divergence. And the reason is because you see in the pre-market here, it fell down to a low of 129.80, and you had your RSI down here in the pre-market at, it was under 30. It was oversold at that point, right? And then it came up at open, dropped back down, and now kind of touched that bottom again. So this is basically what's called the double bottom, right? Because you have a low here of 129.82, and then you have a low here of 129.80. Okay, so this basically said, I'm not going lower than 129.80 right now. Okay, but you also have the bullish divergence here. And what makes this bullish divergence? Well, as you could see, the purple line here, this is your RSI 14. The purple line right here is showing you that the RSI was higher at this point than it was at this point when it hit that 129.80. So what is this telling us? This is telling us that now when it's sold off again to 129.80, not as many people are taking a loss at this point as they were here. It's showing more relative strength at this point. So that's my favorite way to use RSI, is when I have a double bottom or a double top, and I also have divergence on the RSI. As you could see, it would have paid nicely here if you bought calls off the bullish divergence on the RSI and the double bottom, because if you bought calls here, you would have made money right there. It went up. There was basically no red candles until 20 minutes in, right? So that's a way that I use RSI. And then bearish divergence is basically the opposite, sort of like what it did here, where it hit a top here, had the RSI was up here around 69. Then it hit another top here, but now the RSI was lower at 64. So this is showing you now that not as many people are making a profit at this point now as they were here. And now this could be getting sold off because it topped out twice, and it also had the bearish divergence on the RSI. And lo and behold, the candlesticks did come down for a little while. Then it tried to make another move up. Again, more bearish divergence on the RSI as it's lower than those prior tops, and it came down once again. Okay, so that's basically all I wanted to talk about with RSI. Before I move on to the next indicator, does anybody have any questions about relative strength index? You could speak, you could unmute yourself and speak, or you can type in free live stream chat to ask a question. If there are no questions, I'm just going to move on to the next one.
I'm trying to find an example of hidden divergence on the charts, but move on. And if I have one, we could come back, circle to it at the end.
Cool. Also, Amy, you're muted on Discord.
Discord. Oh. I am trying to find an example for you guys of hidden divergence. We'll circle back out around to that because that's one of my favorites. And I thought it'd be a good little additional point, but we'll come back to that at the end before we wrap it up.
Okay, great. So, all right, cool. So Goofy Guru says that was a great quick summary. Okay, awesome. So I'm going to just assume here that everybody kind of understands what I went over with the RSI, and we could just move on to the next. Amy, are you keeping an eye on the YouTube comments just to make sure if there's any on there? Because I'm not on there.
I am.
All right, thank you.
Couple, and Justin DeCrosa says, hold on, let me unmute here. He did say that I used to really only know RSI is overbought and oversold. I've really been using the RSI a lot now with the price action to get in and out as you're explaining. So that's great to hear, Justin, absolutely. And if anyone on YouTube has questions, I am watching here as well. Thanks, James, for asking.
Okay, cool. All right, great. So we're going to move on to the next indicator then. So the next indicator that I want to talk about now is going to be, search it up here, MACD. How to use MACD to day trade. Okay, so MACD, one specific thing that I look for when I'm using my MACD indicator is called the golden cross. There's also a bearish signal called a death cross. We'll go over that as well. So basically the yellow line's your MACD, the green. Okay, so that's for Webull. It might be different colors on your platform. So we're just going to go to the next. Basically, the indicator is better used in pair with other indicators to determine a buy sign. Again, just like the RSI, right? Because just because I have a gold cross doesn't mean I want to buy right away. Just because I have a death cross doesn't mean I want to buy a put or short right away, right? This is an indicator that, in my opinion, is better used in pair with other indicators such as moving averages or exponential moving averages, or using the RSI with it, right, to find that divergence plus the golden cross, right? It's one of those things that when you get it, it's like the cherry on top. Okay, you get that gold cross for your bullish day trade. That's like the cherry on top of everything else that looks good. Okay, in this okay, so we're just going to move back over to the charts here. I'm going to turn on my MACD. Alrighty, we're going to make it nice and big so everybody can see. Okay, so now you have your blue line. I'm sorry, let me just get the chart a little bit here because we do want to be able to see the chart too. Okay, so now you have your blue line is your signal line, and your orange line here is called your MACD line. All right, the colors are going to be different on Webull or Thinkorswim or whatever platform you may use. Okay, so just remember when you're using this, signal and MACD line. So you want this. So when you're looking for a golden cross, you want to see the blue line here, the signal line, cross above the MACD line. Okay, when you get this cross like it's doing right here, this is a bullish sign. This is on your 5-minute chart. So you get this cross here, and you also have the you have actually here from the day before. You could actually do something like that, right? Now, at this point in the morning, you're not sure if this trend is definitely going to hold up or not, but sometimes you could draw something like that when you see that bottom, okay? And you could kind of assume like maybe that's the trend it's going to stay in for the day, right? So you have your MACD cross here. It goes up. Stock goes up as well. And then on the other side of the coin, you have the MACD going down here, right? You have the signal line crossing under your MACD line. So this is called the death cross now. So when you have this, this is a bearish signal. Okay, so this means that the stock could come down from here. Now, personally, I like to use the MACD on the higher time frame charts, if that makes sense. Like the 5-minute is good to use it on, but my personal favorites would be like the 15, the 1 hour, the 4 hour, and the daily. Personally, I just think that when you see a cross on like one of these further out charts, that it's a little bit stronger, okay? And it also gives you a little bit better of an idea of what can happen for the long term, right? Because you see you had your bearish cross here on Apple, you had your death cross here, and the stock basically did nothing but fall from that point on, okay? Until it finally curved back up. We had that little bit of a relief rally, and then again crossed back down, and now here we are going down again, right? Now, again, this isn't an indicator that should necessarily be used just by itself. And here's a great example of why. You have your bearish cross right here. So if you see on the daily chart that Apple had its bearish cross right here on this day, and you buy puts, you're basically not going to get much out of it, right? Because look, the MACD may have crossed down, but after it crossed down, the stock went back up here. The MACD never gold crossed at that point again. It actually hit resistance right at the MACD line. You see that the signal line hits resistance at the MACD line. That's also a thing too. You could actually find resistance like that as well. And you could see that even though it crossed down, it still came back up. So if you bought puts here, you're buying them at the wrong time, right? Because you could see, oh, wait, it went back up. See, and you wouldn't want to buy puts there because you can see that this is clearly in an uptrend at this point, right? So when it came down here and it bearish crossed, you could still see, oh, wait a minute, there's an uptrend here. I don't want to get into puts yet, right? So that's why I say MACD, I don't like to use it by itself to find entries and exits. I like to use it in pair with other things. Does anybody have a question about MACD, gold crosses, or bearish death crosses? If you have any questions on this, please type in free live stream chat or open up your mic. Or if you're on YouTube, you could obviously comment on there too. See, we have somebody typing. Do you prefer it to be above the 0 line? No, not necessarily. I mean, look, that's better, obviously, when it's over the 0 line. But it doesn't necessarily need to be over the 0 line. Like you could see right here, okay, it came under that 0, right? And then it kind of went back above it here, right? So that could be a way that you could use it too, but it doesn't necessarily have to be like that. Right? And again, this is just kind of something that's more like just pairing with other things, right? Like I'll come here and, I'll turn on my simple moving averages, right? I'll come here, I'll turn on my SMAs, okay? And, these are a couple different SMAs. These aren't really necessarily the ones that I use, right? Like I use like the 5 and the 9 and stuff like that. But like that's the type of thing that I'll use with the MACD. I'll use my SMAs, I'll use the trend lines, I'll use the divergence, right? Because what I'm looking for with this is just for it to be the icing on the cake in the trade. It's like, oh, okay, we have the 5 crossing above the 9. Do we have also a golden cross? Yes. Okay, A+, we're getting into that trade, right? Because we see 2 or 3 things that all make sense for it to go up from that point. And then vice versa, bearish trade, right? We see the 5 crossing below the 9 MA. You got your bearish divergence, or it's in a downtrend, hitting resistance, whatever it may be. Okay, great. We also have the death cross. Great. Icing on the cake. Perfect. So let me get into that trade. right? It's something that adds confidence to my trades. It's not something that I necessarily use as an indicator to enter or exit, if that makes sense. Alrighty, so does anybody have any more questions about the MACD before we move on? Perfect. All right, so everybody understands MACD. Awesome. Okay, I'm going to turn this back off here. Amy, did you?
Yeah, you want me to show an example before you move on?
Yeah, sure.
Okay, perfect. Let me share on, let me make sure I'm unmuted both places. Okay, perfect. Let me share my screen on YouTube for everybody, and we will go over this. Okay, so hidden divergence. All right, so here we're on the 5-minute, we're on the SPY. All right, and I already have it squared off. You could see right here compared to here, we're moving down. And on the RSI right here compared to here, we're moving up. So what that tells us is even though the RSI is ticking up, that we're going to start breaking down. And that's what we did. Because this is the 5-minute, we ended up breaking down for the next hour at that point. And another key factor of that is, and a little secret, and I never give these secrets up, guys, I never feel fully confident in a SPY trade unless we have a 5-minute candle close above the 50 RSI. That's a little secret of the RSI. It usually only works well for blue chip stocks. Fully warned, I'm not going to go into the rest of the details on the setups I use for that. If you want to know that, schedule a one-on-one. But we didn't have that RSI over 50 either. So that's a point where it's not the setups we like to see. And then if we scroll over, these are a little bit shorter term, but you could see here, this is the 5-minute chart. You can see this wick closed higher than the wick before. So on the chart, it's showing the uptrend, but yet on the, it's showing downtrend. So it's hidden, this is hidden bullish because this is showing, oh, RSI downtrending, taking down, we're coming down. But then we have this strong move up after that because we could see the uptrend was showing in our chart, yet we were ticking down in our RSI chart. Same thing here. We're ticking up in the chart on our RSI, yet here, this candle closed lower. And this is, I didn't have time to look for better examples. The first example was a really nice one. This is an extremely short term using the 5, but you can see over the next 10 minutes, we had a major dump. So even though our RSI was showing us a tick up and we're way down at 30, we were almost getting into oversold territory, we still ended up dumping. That RSI gave us a little hint right there, and it's hidden because it's doing the opposite of the chart. So that's an example of those. This is the clearest one with the best strength, as you could see here. Uptrend on here, downtrend here. So that's the hidden bullish and bearish for you guys.
Awesome. Yeah, I think that's a great example.
Right on.
Yeah, I would agree with you on the 50 RSI thing. I'm not as like picky about it like that, but I do understand what you're saying with the RSI being 50 or higher is always a good thing. I get what you're saying by that. So
it's like it's catching steam. It's that train starting to like get a little steam. If you just go back on a 5-minute chart, guys, and you just plot big chips only, blue chips only, top 10 companies, your Facebooks, your Apple, these type of things, and you just plot the RSI when it pops over 50 and stays there. Look at the strong moves it has almost every time. You could see these are pretty. I mean, I'd say 80% of the time you're going to get a nice strong move day trading options if you wait till that close over the 50. So that's all I got.
Nice. All right. Well, there you have it, folks. That's your RSI. That's your MACD. Right. So those are two very simple indicators that you guys can use in your trading. There's a lot of complicated indicators out there. I see a lot of people with a million lines on their screens, right? And sometimes you don't need that, right? Sometimes all you need is a good trend line and some nice divergence, right? So, keep that in mind. Simplify things for yourself when you take the trades and when you're finding your own trades and exits and entries and things like that. That's pretty much it, right? You just kind of want to be more simple on your charts. Okay, so let's move on to the next thing I wanted to speak about today, which is going to be your volume. Here we go. All right.
Volume is my favorite of anything. I think volume tells the biggest story aside from candle formations. Go ahead, James.
Yep. So that's the first thing I say right here, right? Is volume. It's one of the most important indicators for stock trading and often the most overlooked. I can't tell you how many traders I talk to and they don't even take volume into account. Volume tells you how many shares are being traded on any given candle. Often when buying a stock for a day trade, you want to see that buying volume exceeds the selling volume and vice versa. When you're shorting or buying puts, you want to see the selling volume exceeding the buying volume. Also, this is something that I wanted to mention too, especially for a lot of newer traders out there that might not really realize this, is that during the pre-market and the after hours, the stocks can have huge moves on very low volume. Okay, so this means, what does this mean? This is like when you're watching a stock after hours, especially penny stocks or the ones that aren't blue chips and, Snapchat, all those types of companies that have volume every day, right? This doesn't necessarily happen on those. This happens on the stocks that don't have a lot of volume every day and don't necessarily have volume in the after hours too often. Okay, so what ends up happening on these stocks is in the after hours, you'll see a bid and an ask. But the ask is going to be way higher than what the price of the shares are. And the thing is that if somebody hits the ask with one share, like for example, a stock trading at $10 and the ask is 20 after hours because there's no other orders, so it's just a $20 ask, somebody buys one share for $20, and then boom, it looks like the stock just went up 100% in the after hours, right? When it was only one share. Okay, so that's something very important that people need to realize, is that during pre-market and after hours, generally the volume is not so strong. So generally those moves in the pre-market are not too important. I could tell you the stocks that it is important on are going to be like SPY, Amazon, Apple, Facebook, right? All of these stocks that are just going to move with the indexes automatically off of the morning, right? Those are the ones that the volume on them is real, and it does matter, those. But the ones where you see like these one share buys coming in after hours or these one share buys in the pre-market, those are not real. So don't ever get tricked by that. And that's also why I always tell people it's good to have the access to the time and sales and also to the bid and the ask, because this will help you to see if things are actually moving or not. Okay, but another way that you could do this without having time and sales or bid and ask and paying for those subscriptions is by just looking at these bars right here, right? So these bars right here are all your volume bars. The green bars means there's more buying volume, and the red bars means there's more selling volume. Okay, so generally what you want to see, especially like if you're looking at something on the daily, you want to see some nice buying volume. If you're going to go long on a stock, you want to see that this had significant buying volume on that day and that the buyers are stronger than the sellers. Okay, so as actually something that's interesting in the stock market too is that generally the red days have more volume than the green days. I think Amy can attest to that as well, that we always see that the bearish days generally have more volume on them than the green days. And the reason for that is pretty much because fear is a little bit stronger than greed, right? When people are selling and everybody's scared, you're going to get way more shares being sold, way more volume than when it's coming back up, because people are more hesitant to buy back in now after a large drop, right? You have people who are waiting, and then you also have people who have fear of missing out, so they're going to buy it anyways, right? But generally the red days have stronger volume on the daily chart, so you can use like the 5 minute or the 1 minute. And what I like to see, when I'm about to enter calls or something like that, like I like to see something like this right here, right? Okay, it broke resistance and we got a nice shoot up on the volume here, right? We had all these little volume bars, and then boom, right here we had that large spike in volume. So that's a good sign that it can come up from here, especially because it just broke this prior resistance, right? It's breaking this top that it couldn't get over here. It broke it, and you also had the higher volume here now. So this is a good sign that it could continue up a little bit from here. Amy, would you like to add anything on the volume?
I would. Thank you for asking. I've got the chart pulled up here. Okay, so I'm on the 5 minute of the SPY, of course. We're going to focus on this area here. Let me just highlight it so you guys know where to look. All right. So I'll show you exactly what I'm looking at when I'm entering a trade. It's a pretty nice setup here. So we could see we're downtrending, we could see we're downtrending this whole way. Okay. And these candles are pretty strong volume. I mean, look at these in relative comparison to down in here. Okay. And as you can see in here, this is where we're starting to exhaust ourselves, this candle here, because we have a low volume green candle and we started to uptrend here. And then we peak some volume. We have a candle with like probably a third to 40% more volume here, and it exhausted itself, meaning the entire body of the candles at the top. We have a full wick at the bottom, and the sellers are literally exhausting themselves. And then our confirmation is the next candle we turn green with very, very low volume. So we went from almost double the volume red candle with the body of the candle all towards the top. So it was starting to push up towards the close of that candle. And the next candle on very low volume, we turned green. So this is telling us that if we get a little volume, those candles are going to blast green. And sure enough, boop, 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 we have 3 white soldiers in a row after this doji turnaround hammer. This one's a little bit of both at this point here. A hammer is where the body's a third of the wick. So it's not quite a hammer, but you can see here, low volume turned green, little more volume, and then blast off. And then this candle, we have less volume and the strongest push. So that tells us as long as we could sustain this type of volume, we should hold this level. And this is a good point for continuation too, because we have low volume, these entire candles here. And when we do have a large red candle, the sellers couldn't take over. We stayed up in this area. And in this area, yes, this could be a shakeout area here, but in the relative comparison of the volume, we could see the same setup again. High volume red, and then we exhaust ourselves. Then we turn green on a low volume candle. And then look, we have continuation straight on up for the next hour and a half. And just pretty much, even this candle here we go. This one would indicate bearish. So this one's actually a little tricky because low volume, extremely red candle. But then that next candle immediately pushes you back up. So when you see after a strong bullish or bearish push, a reversal candle on low volume, if that volume starts coming in, it's going to be a nice push.
Also, Doctor said, are you buying on that third green candle?
I'm buying on the first green candle.
Hey, Sahid 2021, can you just mute your mic, please?
On something like this, when I see these turnaround, whether it's a doji, a hammer, this or that, I'm buying here. And if I don't end up buying here, where I am buying is this third candle when we pull back and then blast up again, and you still get that secondary push. Plus, if we're playing that RSI 50 game, we would take it here. But yeah, I mean, honestly, I would be on a 1 minute for my entry. So I would be looking, here's our chart right here. So for on the 1 minute, which is what I'm playing with my entry anyway, you could see this very similar type situation. This bottom volume bar, we get that volume coming in, we exhaust ourselves, and then we just start pushing. And these candles here, this is that confirmation. Very, very low volume, we stay green. Volume kicks up, green, volume kicks up, more green. And then in this area here, that's why you flip. Once you're in a trade, that's why you flip to that 5, because this looks horrible on a 1 minute. But if you flip to that 5, it looks fan-freaking-tastic for continuation. That's why we flip to the 5 once we're in a trade. Hope that makes sense.
Makes sense to me.
I am. I mean, I'm a little aggressive, though, guys. You guys know that. I'm aggressive with my entries, so.
Yeah, we're trying to get those good entries, right?
Mm-hmm.
Right? We've been around the block a few times. We know how it all works out there. So anyways, that's a great explanation on volume. So thank you for that too, Amy.
You're welcome.
All right. Does anybody also, Anil asked if we could take a look at A. I'm going to guess that's talking about Agilent Technologies, correct? They said, observed a spike on volume on Friday on the 1 hour. Which volume it was? Let's take a look. Okay, so on the 1 hour,
That's if you look every single day, we're getting that volume spike. One thing that's telling me is we're getting some whale buys, and it could be hedges against puts or hedges against calls. What do you think, James?
You think you would do like both? You're saying you would do calls and puts?
No. Not that I would do both, but he's asking. Look at the volume spikes at the close of the day.
Yes.
Like you can see the close of the day volume spike here, and that could, but that's after hours, isn't it? That's a good question. I couldn't.
Actually, no, it's not after hours.
It's is it? It's not. My
No.
chart shows after hours. Okay.
No, what I have here, actually, no, there was no. It doesn't even look like there was really any.
Yeah, I mean that's every chart. You get that 5 minute about to close 5 minute surge. People are exercising contracts. People are adding up for the next day. People are loading the boat in anticipation of the next day being bullish, bearish, etc., etc.
Oh yeah, for sure. At the end of the day, you always get a huge volume candle on a lot of things.
Yep.
Yeah, for sure. Yeah, you could see like a 1 minute candle on SPY worth 6 million, 7 million shares at once. So at the end of the day, you always kind of get that. And sometimes that end of the day volume, whatever that spike in the volume is, can tell you the story of where it's going the next day. However, in the market that we are in right now, I would not trust that whatsoever overnight, because it's just a bunch of traps. It's a roller coaster ride. We had that day where where they reported the interest rates and the market went up. And we had that big spike in bullish volume at the end of the day, and then the next day the SPY dropped $10 in the pre-market. So don't use that end of the day spike right now. I wouldn't use it anyway to try and figure out which way the stock is going the next day. Try to predict that. It doesn't work as well right now. It used to work very well. I don't see it working too much as often now. And that's the thing about the market. It's ever changing. We have strategies that we use, and they always worked, and they worked. And why aren't they working anymore? And it's just because the market changes. So we have to look at what is working now, and we have to find those strategies, and we have to readapt our trading. And that's it's an ever going cycle of learning and figuring it out. That's basically it, right? So in this market right now, those end of the day volume spikes, I don't really care for them at the moment. DMFG also said, how do you determine in the money versus out of the money strikes and even several strikes out for SPY calls and puts? How do you determine them? Can you just elaborate a bit on that? I'm not sure what you mean. Determine
which ones we're buying?
Yeah, is that what you mean? Like, how do I find the one that I'm buying, or are you just asking how do we know? Sorry, go ahead.
Yeah, right. So, what are you looking at the Greeks to see whether you're going to be close to the money or several strikes past? Put your call outs. I just always wondered how. Yeah. You determine which one's better. Is it just because of the price? Some are more expensive than others.
Yep, definitely. So I'm gonna actually switch my screen right now because I was gonna actually start going over all that option stuff now too. So perfect question to lead into the next. So let me just reshare.
I'm grabbing a drink. I'll be right back, yeah.
Okay.
Oh, my boys and my girls.
Alrighty, switched it on StreamYard. Got to switch it on Discord too. Just change to Weeble. All right, cool. All right. So let's go over that. Let's go over that first. Let's talk about the Greeks first. And then this will answer that question that you have too. So with the Greeks, you have your theta, you have your delta, you have your gamma, you have your implied volatility. You also have volume and open interest, which aren't necessarily Greeks, but those are good things to look at as well. Okay, so now when I'm choosing one of these, let's go to SPY since you asked about SPY. So first thing I'm going to look at for a day trade is going to be delta. I always want my delta personally to be, for a day trade, at least 25 or higher. So if I was going to trade this option on Friday, the furthest one out that I would go for would be this 372, maybe this 371. I always want it to be at least 25 or higher. That's just the way that I trade. You could also make money on the ones that have lower delta, but I don't like those as much because they're a little not as easy to profit on, because the stock kind of needs to run a little bit more for the calls and drop a little bit extra for the puts for them to actually come up as much as you want them to. So I usually like to go 25. That's my floor on the delta for the day trades. As far as the swinging goes, my floor on the delta is usually 30. I just give it that extra 5 for the swings. Now, your delta can be looked at as the percentage of chance that the stock has to hit the strike price by the expiration date. So that's another reason why I like 25 or higher, just because I like to trade the options that have at least a quarter of a chance to go to the strike price by the expiration, because these are the ones that are going to get a little better volume, a little better open interest, little just better action on the price in general. So delta, that's the first thing I look at for the day trades. Second of all, for the day trades, I always look at my implied volatility. So on SPY, you're generally not going to have too high of implied volatility. Recently, what we've been seeing, if I would show you the 617 options. But tomorrow, on Tuesday, when these options open up, the implied volatility on these is most likely going to go up a little bit. And the reason for that is because we've been having a lot of roller coasters in the market. It's going up a lot. It's going down a lot. There are very big moves. So when you're getting big moves, the implied volatility goes up, because now the market consensus is, okay, this stock can move a lot, so we're going to actually jack up the option prices because it's worth it, because traders will pay those jacked up option prices because they know that SPY can move a lot. Right. So on Friday, these closed at 20% implied volatility. However, on the ones that have been like same day or the next day and things like that, I've been seeing on SPY options as high as 40, maybe even 50%, which is pretty high for SPY options. But anyway, for SPY, the whole thing about this is you could pick pretty much any option under the sun. So for SPY, the most important thing is the delta to me. So 25 or higher on the delta for the day trades, 30 or higher on the delta for the swings. And the reason you could pick any option under the sun on SPY is because every single one of them has volume. Every single one of them has open interest. It's always going to be like that because this is the most heavily option traded stock in the entire market. Okay, the most options traded are on SPY. So this is a very easy one to choose your options on. Basically, all you need to worry about on SPY is the delta. Everything else always checks out. Maybe your implied volatility. Maybe you don't want it to be. Maybe you don't want your IV to be so high. That's another thing you could look at. But main thing is the delta. However, if we move over to a different stock, like let's say XOM, for example, we can see that now this is a little bit different. Okay, the options don't have thousands of open interest. These options have thousands of volume, but not all of them do, right? So you can't pick any one of these options and be satisfied with it. So for this, we have to dive a little bit deeper here now. So we're going to look at the delta again. So we want to pick one that has 25 cents or higher for a day trade, 30 cents or higher for a swing. Implied volatility, what I always say for implied volatility is anything from 15% to 60% is in the low area. Anything from 60% to 90% is in the mid range. Anything from 100% or higher is in the high range.
And I love those.
Yeah. So yeah, Amajama loves those high IVs, right? But so when you have a contract that has the higher implied volatility and you're taking it for a swing or a day trade, what could end up happening is you could buy it and the stock could go in the direction that you want it to go, and then you still don't make money because the IV is dropping on you as the stock goes up. This is a very possible thing. This is a situation I've been in many times. So that's why I always check the implied volatility, because I want to make sure that I'm getting a decent deal on the IV, right? Because if the IV starts dropping on me, if the IV is 120% and then the stock comes up, but my IV goes down to 90%, that's a lot of value that I'm losing off my option. So my option could still be at break even at that point, right? So we want to make sure that we don't buy ones with too high of implied volatility. As far as swinging goes, Now we have to take into account the theta. So for the theta, the way that I look at this is as compared to the price that you are paying or the premium of the contract itself. So basically what I mean is this 5-cent theta may not seem like a lot, but 5 cents as compared to a 20-cent contract is 25% of the contract's value that's being lost overnight just for holding it, right? Because that theta is a decay. So overnight, this contract loses 5 cents worth of value. This is losing 25%. So that's a high theta, right? And then as compared up here, you have a 16-cent theta, and the contract is trading at about 180. So, let's call this 17 or 18 cents even. That's still less than 10% of the contract's value, right? So this is a safer option to get into now because the theta is only 10% of the contract's worth, whereas over here you have 25%. So that's another thing you always want to look at. As far as theta, when it comes to swinging, on the high risk side, I'm okay with the theta being 10 to 15% of the contract's value. On the lower risk side, long swing kind of thing, I don't even want it to be I want it to be 1 or 2%, and that's it. Okay, and then last but not least, when looking at options to choose which one you want to buy, you have to look at the volume, you have to look at the open interest. So the whole thing about this is that you don't need the volume and open interest to be sky high unless you're trading hundreds or thousands of contracts, right? Because if you're only buying 1 or 2 or maybe even 3 or 4, that 722 open interest is going to be just fine. That volume at 4,000 is going to be just fine. However, if you're somebody who has a little bit more money, right, and you're trading big amounts and you want to buy 800 of these contracts, well, you better make sure that you have good volume on them. You better make sure you have good open interest on them. However, for the type of trading that I would assume most of our members do, I would say that at least 100 volume and at least 100 open interest is good enough for that type of trading. Okay, but when you have low volume and you have low open interest, you also want to make sure that your bid and your ask are not spread too far apart, right? Because 180 bid, 189 ask, that's not so bad. Okay, you could bid somewhere in the middle here. You could bid at 184 and get it for that, or 185. All right, but if you have one that has a much higher spread, where you have these options like, for example, on AutoZone, because these options don't get a lot of volume, right? These have very low volume every day. So look at the bid and ask spreads on these. These are very high, right? Even down here in the low ones, you have the 2085 call. $5 bid, $13 ask, right? So that's a huge difference. So you don't even want to, in my opinion, I don't even want to touch that, right? I'm not even going to touch that. It has 2 open interest, which means in the entire market, there are only 2 of these contracts being held by anybody out there. And it has 0 volume for the day. And most likely it has 0 volume on most days, right? Because there's only 2 open interests. So who is trading this? Nobody. So we don't want to get into options that nobody is trading, because then it becomes, number one, you have to pay up to get the option. You have to pay close to the ask, if not the ask itself. And then number 2, when you're ready to sell, it's going to be much harder for you to sell because you have these low bids. So you have to put up an ask now and hope that somebody comes along and does the same thing that you did and hits the ask. Right. So I just kind of want to avoid that type of stuff overall. Right. So I'll never buy any of these options. Right.
I think new traders, a lot of time when I'll get sent a chart, like, oh, I want to buy this option, this and that. If you're newer to options, you'll find fantastic setups, and it might have just trash Greeks and no interest and this and that. And I think that comes with time. Not only do you have to have the setup, you have to have the right options set up for it as well. It's like a double-edged sword, makes it even harder.
Yep. So yeah, you could find a good setup and it looks great, but then if the options are no good, don't buy them, right? Just don't even waste your money on buying an option. If you want to go long on the stock and the options suck, just buy the shares instead. Do something else. Don't waste your time with the options, because it's going to be, number one, hard to buy it for a price you want, and then hard to sell it for the price you want to sell it for. And that's when your volume and open interest is very low, or when you have a very wide bid and ask spread, just to reiterate. All right. Is there any questions on that? Right. So that's all your Greeks now. So that's your theta, delta, implied volatility. Okay, you have your volume, your open interest. These are the 5 most important things to me when choosing the trade. I don't really care for gamma too much. It's not that important to me. If you guys want, I could go over gamma too. Okay, but it's not really that important to me in my opinion. But basically what your gamma is going to show you is the amount that the delta will rise for every dollar that the stock goes up. Okay, your delta is the amount that the contract will rise for every dollar that the stock goes up, right? Or at least the amount that it should rise, right? Because options aren't always going to track perfectly. Okay, it's just an estimation. So in the end of the day, okay, SPY is at 366, let's say. This 366 call is 430. The delta is 50. All right, so if this goes up to 367 now, the contract should raise by 50 cents. The delta will go up by about 4 cents because your gamma is around 4 cents here. And then your delta now becomes, let's say, 56 at that point. And then by the time it gets deep in the money like this, you'll see on all the in-the-money options, you have your delta at 99, 99, and then sometimes it can even go to 1, okay? When it's really, really deep in the money and it has a lot of time left on it, it could be a 1 delta. But usually it's just like 90, 80, 99, okay? But that's when it's deep in the money. Dr. Doc has said, do you think Rho has affected some option leads lately since it is affected by interest rates? I don't really even look at Rho, that option, to be honest with you. It's the rate at which the price of a derivative changed relative to a change in the risk-free rate of interest. Rho measures the sensitivity of an option to change in interest rates. Rho may also refer to the aggregated risk exposure to interest rate changes that exist for a book of several options positions. Okay, so then I mean with the interest rates changing and things like that, then the Rho has definitely affected the leaps. Sure.
And if you go back and look at leaps, relative comparison, it would take a lot of time, but relative comparison, say we lost 20% on a stock a year ago compared to 20% on a stock this year. A year ago, an 18-month out leap with a 20% loss would be maybe a half of what you lose this year on a leap. I'm sure you guys have noticed a leap on a higher volume stock, Apple, something like that. Your leap is affected in a much deeper way with the sell-off than like a year ago. Usually it'd be like, oh, we have time. It's 18 months out. You lose like 6%, 8% over like a red week. It's much, much different now. So I do think that is part of the reason why. I've been trading options a long time. I'm sure James has noticed too. The depreciation seems definitely harsher this year, I would say.
Yeah, I would agree with you on that. To be honest, though, I'm not even holding many leaps. I kind of gave up on the leaps for a little while. I'm waiting to get into some of those. So I haven't even really been watching leap contracts like that. But I take your word for it, and I think that would make sense, that they would be depreciating in value because of that, for sure. Yours is on KGC.
We're about the short swings right now. We're swinging, just not leaps right now, not the big money plays.
Yep. So KGC, that Dr. Obviously you know, but for those that don't know what KGC is, this is a gold company, right? So this usually tracks with how gold does. So you could actually come here and look at XAU USD. This is your gold to the US dollar. Okay, but one thing that I've noticed, right, is that usually in a bearish market, in a weak market, generally we see the price of gold rise, right? Because it's something that's supposed to be a safe haven for investors. It's supposed to be where people run to hide, essentially, right? They run to gold, they run to silver, other material items like that. They'll buy. So you could see though that this really hasn't had any true pop, right? It hasn't really been doing much right now. I think that eventually it will, especially when you see Bitcoin crashing the way that it is right now. Bitcoin became something that people said it's better than gold. This is the safe haven now. Bitcoin is the new gold. This is what people were saying back then. And wow, do they sound stupid now, don't they? because that's not really working out too well for them, is it? Because if you threw all of your money into Bitcoin when it was 40 or 50,000, thinking this is where my money is going to be safe right now, and now you're down 60%, you know, it's not a safe haven for money at all, not at all, right? But neither, and gold should be usually, right? But it's kind of just trading sideways. It's not dumping. Okay, it's not dumping, so it is holding up. It is staying the way, you know, it's kind of safe, right? But it's not really going up either. It's not really yielding profits, is really the thing that I'm trying to get out here. So as far as KGC goes, I think it's going to take some time. You know, if you're in like 2024 on the KGC leaps, I'd say you're probably going to be all right. If you're January 2023 on the KGC leaps, I'm not really sure if I like that as much. I think that you need more time personally. Okay, cool. 2024, perfect. Anil said, so do you have a set of stocks to check every day for volume analysis, or will you screen the stocks to fall into your category? Right. So there are just certain stocks every day that I know that are just going to have good volume on the options, right? Apple, SPY, Facebook, Citigroup, Bank of America, Tesla, Roku, Walmart. There's tons of them, right? So I don't have to look at the volume analysis. That's not necessary in the morning. You just could have your list of stocks that you want to trade and know that they're going to have good option volume, and just trade those. And that's kind of what I've been doing. I've been sticking to a set group of stocks that I've been trading. I'm mainly staying in the same sectors, such as banks, grocery items, food and beverage, telecommunications like AT&T and Verizon, right? They give internet service. Everybody needs your internet. Everybody needs internet, right? Charter communications is another one, right? That's one that should hold up. So, and also, of course, oil, right? Because oil is very hot right now. Gas prices rising up the wazoo, right? So the oil stocks are going up with it. We had a nice pullback on Friday in the oil stocks. That's why I grabbed XOM calls. I grabbed XOM calls for July, and I also grabbed some for September as well, because I like that level that it was at on Friday to go long, especially going through the summer now, right? We're not even in the summertime yet. We still have 2-3 days left to go before summer starts. And generally during the summertime, the gas prices go the highest. So I do not think that we have seen the top on the gas prices. I think that they're going to go higher, and you're going to see XOM and all those kinds of BP, all those stocks go up with it. Alrighty, so that's your option Greeks. We only have a couple of minutes left. I do have to get off at 9 o'clock. I can't stay late today. I'm sorry, guys, but I did want to go over the debit spreads and the credit spreads. So I really only have time to go over one of those right now. So we'll do one today, and then whichever one we don't do today, we could save it for next Sunday. So sound good to everybody? So you guys let me know in the chat, which one would you rather I talk about right now? Would you rather learn about the debit spreads, okay, or the credit spreads? Credit? All right, so I got one vote for debit, one vote for credit. Whatever the next one is what it's going to be. Okay, it's credit. We got 2 on credit, we got 1 on debit, so we're going for credit spreads.
You sound like an auctioneer. Ready, set, go!
And we got the credit spreads on 1 and credit spreads on 2. All right, so here we go. Let's take a look at Apple for the credit spreads. This is kind of the one that I wanted to go over one anyways, because I feel like this one people might not understand as well, right? So credit spreads. Let's go over 2 types of credit spreads right now. Let's go over the bull put spreads and the bear call spreads, because these are your most simple types of credit spreads. Okay, I'm going to switch back. This is going to be a little annoying for everybody, but I'm going to have to switch to one screen and then switch to another screen in between, okay? So I'm going to switch my window to what I need to switch it to in just a moment. Okay, sorry. Okay. Alrighty, so let's do your bull put spreads first, right? This is one of the more common ones that we also see more alerts for in the Discord. We don't really see a lot of bear call spreads being alerted in the Discord right now, although I personally plan to change that as I want to start alerting more of these types of plays. All right, but let's talk about bull put spreads. So what you're going to do first is you're going to buy to open a put contract, and then you're going to sell to open a put contract with a higher strike for the same expiration date. So what does this mean? I'm going to buy to open a $50 put, and I'm going to sell to open a $60 put. Okay, so now when I sell that $60 put, that put has more value to it than the $50 put, which means that this transaction results in a credit received. The credit is equal to the price you sold to open the higher strike, subtracted by the price you bought to open the lower strike. All of these trades require a collateral. So the collateral that is required for this type of spread is equal to 100, the number 100, multiplied by the distance between the strikes. This is also the maximum loss that can be taken on a trade like this. And what does this distance between the strikes thing mean? Basically, if it's a $50 put and a $60 put, the distance in between them is $10. You take 100, you multiply it by 10, gives you 1,000. So you need to put down $1,000 collateral for that type of trade. Now we could obviously go to the smaller side of things too. We see some options out there that have, we see the $49.50 put, and then we also see the $49 put, right? Like Intel has those sometimes. So you can do that, and if it's $49.50 and $49, then your collateral is only $50 for that, right? So that's why you could actually build up a small account using these types of spreads if you choose the right ones. And we also have our shot caller LT, who has the tiny account alerts that she alerts the credit spreads on. And if you guys have small accounts like $100 and that's all you have to play with, honestly, I would definitely suggest sticking with her on those
1,000%
for a while. Build up the account, get it up to $1,000 by doing the spreads. Eventually, you make $10 here, you make $6 there, $7 here. It all adds up. Eventually, you're going to have more money to be able to do spreads that cost more, right? That you need to put down more collateral for. So it's a marathon, not a race. Just take your time and do it. Anyway, the strategy is if you are bullish on a stock, but don't have an idea of exactly how high or how long it will take for the stock to go up, a bull put spread is a safer, quote unquote, right? Because nothing's technically safe, but it's a safer strategy because you need the put value to decrease, right? You don't need these puts to go up in value. A contract loses value way easier than it gains it most of the time, right? Because you also have the next thing here, theta. The theta is on your side. So you're collecting profit off of the theta decay, especially if the stock trades sideways, right? How many times do we see, especially with the earnings, where the stock opens up sideways, effectively killing the put side and the call side, right? And then theta wrecks it too. So when you get that stock trading sideways, this kind of a spread could be good if you pick a strike that makes sense, right? Because you don't want the strike to be in the money. That's basically the ultimate goal, is you do not want this spread to be in the money. Okay, and I'm going to do an example on Webull too, but before I switch back to the Webull, I'm also going to talk about the bear call spreads. First, before I move on, does anybody have a question about bull put spreads? Or do we understand so far? I'm going to give an example too, but just want to make sure everybody gets it. All right, fantastic. So let's move on to the next one. So we got bear call spreads right here, right? So pretty much similar, except the exact opposite, right? It's you buy to open a call contract, and then you sell to open a call contract with a lower strike. The transaction results in a credit received. The credit received is equal to the price of the contract you sold to open, subtracted by the price of the contract you bought to open. Meaning, if I buy a $50 call and I sell a $48 call, right? Whatever those prices, the difference is, that's the price that I'm receiving, the credit that I'm receiving. The collateral is the same thing, $100 multiplied by the distance in between the strikes. It's also the maximum loss that can be realized. Strategies, basically same thing, except the other way. If you're bearish on a stock but do not have an idea of how low the stock can go, or how long it will take for it to happen, this is a safer, quote unquote, strategy, as you only need the price of the calls to decrease to be profitable. And again, theta is on your side because the theta takes away value from the contracts and adds to your profits, and as it trades sideways too. Right? So this is a little bit of an easier way to trade options. It really is. It's easier than buying single legs. And the reason is because these only need to expire worthless. Right? That's all that needs to happen to make money, or they just need to decrease in value. Okay? So when you have a stock, now I'm going to switch to my other screen, and I just realized I didn't share that on StreamYard.
Oh, I should have been paying attention for you. That's
I
okay.
Darn it. All right. That's okay.
We'll get you guys next time.
Yeah. All right. I'm gonna switch my screen to Webull. We're gonna do this really quick on Webull. All right. So anyway, let's take a look at Apple. Let's go to the calls. Okay. So let's talk about the bear call spread first. So basically, let's say by July 1st, you don't think that Apple can make it over $140 by July 1st. Okay, you got 11 days. It has a 15.51% chance of being in the money by the expiration date. It says it right here. ITM percentage is the percentage of chance that the market puts on this to hit the strike price and be in the money by July 1st. Okay, so it has a very low chance of being in the money. So that's good for you, right? You don't think it could go over 140. So what you do here is you sell the 140 call, and then you could buy any one of these under here depending on how much risk you want. But let's say you sell the 140 and then you buy the 141. So you sell this one for, let's just call it 80 cents for now. You sell this one for 80 cents and then you buy this one for 60 cents. Okay, you're going to get a credit of 20 bucks. You're going to put down the collateral of $100. Your maximum loss now is the collateral that you put down, and then you have to subtract the amount of credit you received, right? Because you received this credit, you didn't pay any money for the credit, you just got 20 bucks, right? That $20 is immediately credited to your account. So that $100 max loss, you could actually take off the 20 that you got for free, essentially, right? And now your maximum loss is really 80. Okay. This also tells you what your break-even price is, because the stock could go under 140, but if you got $20 for this, or 20 cents, right? Because options trade by the cents times 100. You got 20 cents for this. You take 140, you subtract 20 cents. 139.80 is actually your break-even price. Now, if it goes under 139.80 on the expiration date, the contract at 139.70, for example, this spread would be worth 30 cents now, right? So you're going to lose 10 bucks at that point now, right? But as you could see, this could be an effective way to make money, because all you need is for these to expire or just lower in value. I mean, look at the theta on these contracts, right? You have a 10% theta on the 140, and this is only going to get worse and worse for the people that are holding it long, and it's only going to get better and better for the people that are shorting it. Because as the theta goes up, this is good for you now because you received the credit. You want this to go to zero, right? And we see, I mean, you can make money off of theta decay, right? Now, obviously, if Apple were to go up too much, right? If Apple were to go up above 141 and 142, your maximum loss is going to be hit, right? So that's definitely a possibility too. But if you want to be a little less risky with stuff like this, and you have a smaller account, try the ones that are way further out of the money, that have way less of a chance of being in the money by the expiration, right? Because it's kind of easy. You could kind of figure out, like, oh wow, you know, today is June 19th. I don't think there's no way Apple's going over 140 by June 24th, or there's no way it's going over 145, right? I'll take the chance, right? Stuff like that. So that's something that you guys could look at for that. So that's your bear call spreads, and now your bull put spreads. And this is going to be my last thing for today. But your bull put spreads are vice versa now. So let's say I'm going to buy this 129 put, and I'm going to sell this 130 put. So now I'm receiving a credit. If I sell this for 160 and buy this for 2, I'm receiving a credit of 40 cents or $40 credit. My collateral needed is $100. You take your $100, you subtract 40, because that's the credit you received, to now get a $60 maximum loss for one contract. 2 contracts, 3 contracts, just add 60 onto each of those, right? But if you're just doing one, it's $60 maximum loss because you received that $40 credit. The $40 credit's immediately credited to your account. The whole goal of this is that you don't want Apple to go under $130. So if it goes under $130, you still have that 40 cents of buffer room to hit your break even. So in reality, your break even would be $129.60 now, because at $129.60 on June 24th, this spread would be worth 40 cents. Anything under $129.60, now you start to lose money, right? Because if you lost the credit, you're not necessarily losing money, right? You're just losing the credit that you got. You're just not getting it. But if it starts to go higher than the credit that you got, now you have to buy it back for higher than the credit you received. That's when you start losing money, right? So you could try to work on these types of options, these types of deals where you could find a good spread, where you can get filled at a good price. Like if you could find one of these where it's $1 in between and you're getting a $70 credit, well, hell, your maximum loss is only $30. That's great risk to reward. And I promise you, those types of trades actually do exist out there. They're hard to find. They're few and far between. It's not easy to find that perfect mint credit spread like that, but they do exist, and you could find them out there and use them to your advantage. When you have a really good risk to reward ratio like that, where your maximum loss is lower than the max you could gain, that's great. So, you could look for stuff like that in the market too. And basically that's the whole point, is you just don't want it to go under that strike price. So you're going to sell the strike that you don't think it could hit. And then you're going to buy the strike under it, or however far under it, depending on how risky you want to be, right? Because I could buy the 125 put and I could sell the 120. But now I'm only receiving a $40 credit for doing that, and then, or a $50 credit rather, and then my maximum loss is going to be $450 because there's $5 in between those strikes, right? So, be careful on stuff like that. Like, you want your risk to reward ratio to be good on these types of trades, right? We don't want to put $500 collateral down to make $50. It's not worth it. But I'll put $500 collateral down to make $200, right? Because that $500 collateral is tough for it to hit, right? Because it has to be on that expiration date. It has to be in the money. All right.
What a lesson. Hold on, guys. Let's give James Legends some comments in the chat here, because this was incredible, well thought out, really articulate, fantastic information, some secret sauce. Like, let's show him some love in here, guys.
Yeah, I really do hope y'all took advantage, learned from this. Like, if you didn't know it already, I hope you learned. If you knew it already, I hope it was a good brush up. I got it all ready for you guys before I started. So it's, nice lesson for everybody. We have it on video too now, so we're going to put it on YouTube so you can rewatch it again. And for those people that didn't get to make it, they could watch it too. Or if you just showed up recently. So yeah.
All right. Y'all rock. Thank you. Maybe we'll try to do a pop-up stream tomorrow. The market's closed. No guarantees. We've got some meetings and stuff tomorrow, but maybe you'll see us pop up somewhere. Thank you for allowing me to join your stream today, James.
Yeah, of course. Thank you for joining.
Of course. All right, we're going to end it on YouTube. Thanks, guys, everybody on YouTube.
Yep. Thank you, YouTube. We'll see